Things are not looking good. Hello, my name is Vincent and welcome to another episode of Brew-time. So I'm going to go grab myself a brew and then we can get started with this video. So it's not surprising that the stock market has not been performing well lately. And in this video, what I want to share with you is some strategies that I employ when my stocks go down and how I manage my emotions and my tactics going forward. Before I start this video, I want to note three things. The first is I am not a financial advisor. I am just a guy who wants to make a better future for myself, and I find investing to be quite fun and a hobby of mine. The second thing is, I'm sharing this with you not to say that I have the stock market figured out, but what I want to do is I want to share with you what goes on in my mind and how I think about things. The third is, I'm making this video because I want to know 5 years down the line whether I've actually done the right thing and whether I've just been a twit in investing. Or if I have been a twit, you can just let me know in the comments below right now. So without further ado, let's talk about investing strategies. So before we talk about strategies when my stocks go down, I want to talk about strategies for when I'm actually buying a stock. So you might see online that you have videos saying this stock will go 10x, or I live off dividends and earn a few £1,000s a month. And this could be true, but this is not true for all stocks because there are different strategies. So the first strategy of investing is value investing. So what this is you look at companies and you find what is undervalued, what is making money but relatively cheap in terms of the stock market performance. The second strategy are growth stocks. So this could be your tech stock or Tesla a few years ago. So what this stock is a stock that will grow maybe 10x in the next few years. The third type of strategy is dividend investing. So this is when you invest in a company that's well established, is constantly making money, and it constantly pays out dividends to its shareholders. So this is a good way of making passive income that's predictable and almost like a wage. The fourth strategy are turnaround stocks. So these are stocks which previously might not have been performing so well, but suddenly maybe a change in strategy or a change in management, these are due to turn around or to grow again. These are typically the four strategies that I look at. There are other strategies out there, but this is what I typically do. So when I buy a stock or invest in a company, the first thing I do is I always look at what the business does. And I typically ask myself a few questions. So the first question is, will the company be around in 10 years? Will it die? For instance, during COVID-19, this is a major global event that could have wiped out many companies, and it probably has wiped out a lot of small companies. But when I look into a business, I want to see whether a company will survive this sort of event and whether it can get out the other side, because I know if it can, this stock will never go to zero. I'll always get some money back. I might lose some money in the meantime, but it will always be around. The second question that I ask is, does it have a large enough cash reserve? Because if it does have a large enough cash reserve, chances are if there is a global event that damages the stock market or damages the company in some sort of way, it'll have the biggest chance of survival. So the third question that I ask myself is, will this company, will this product, will this industry become redundant in the next few years? So for instance, if you think of Blockbuster, that was made redundant because of Netflix, and you have Kodak, which was made redundant because of digital cameras and the iPhone. So I always like to invest in companies that I know will not become redundant and will have customers going into the future. The last question is there anything unique about this company? Maybe this company has a long-standing brand history, or maybe this company is the only company in the world that does it, or is the only company that provides this product in this particular geography. It's these sort of things that give it its unique selling point and creates the economic moat. So those are the questions I ask about the company. Once it's passed all of those tests and I believe it's a good company, then I ask, is it a good stock to buy? So when I'm at this stage, I typically know it's already a good company, but it's just what price do I want to buy in at and how much do I want to pay for it? But this, to be honest, doesn't really have that big an effect on me because I'm investing in the long run. And I always believe, the way I am, I need some skin in the game before I can really invest and know what this stock is doing. So when a stock goes down, what I typically do is I'll re-ask the questions that I asked at the beginning. So will this company be around in 10 years? Has something changed about this company that makes it fundamentally different to when I bought it previously? And again, I'll look at the financial information again. So does it still have enough cash to operate? Has the cash position changed? And again, I'll look at the industry. So has anything in this particular industry made it better or worse? So if all of those questions are answered and I still think it's a good company, then what I got to do is hold on to my panties because I'm in it for the long haul. If that happens, what I tend to do is I tend to average down my position. I know that this is a good company, but for some reason, the sentiment on this stock is just not good. So people aren't paying top dollar for it. But if I know it's a good company and I know it's still growing and it's still producing money, then it will eventually grow, won't it? Well, that's what I'm hoping, which is why I then average down. So that's what I do in the long run. But there are still short-term strategies that I can employ to make money on a short-term basis. So for instance, the stocks that I look at, I'm constantly monitoring the price. So I know what the trading range is. So when you look at a stock long enough, you tend to notice the patterns. You know what the trading range is. You know if suddenly today it's a cheap price or an expensive price. And if you know what the trading range is, short term, what I tend to do is if I think that, oh, this stock is at a particular low point, I would buy in knowing that it tends to trade within a range. It's a bit like if you're into tech. So if you're looking to buy a new TV, you would monitor prices and then suddenly Black Friday happens and the price goes down. What you'd do is you'd say, okay, I'm going to buy it on Black Friday. Same goes with stocks. So if suddenly a red day happens and everything goes down, as long as I know that this company is fundamentally sound, I'll then go and buy in because I know it's at a discount. So this is why I think it's quite important to have some skin in the game, because when you have some skin in the game, you'll instinctively know what is a cheap price and what is an expensive price. Now, there are more technical ways in doing ratio analysis to see if a stock is expensive or cheap, but that's probably a different video. So a good way to mitigate the risks of individual stocks is to buy into funds. So what a fund is a group of investments. It could be bonds, stocks, even real estate, called REITs. So if you buy into a fund, the questions about the company aren't as important because chances are those group of companies are not going to go tits up altogether. So you don't have to worry about things like, does this company have enough cash to survive? Is this product still going to be used in 10 years? Because your basket of stocks will hopefully spread that risk. There are also index funds which track a particular indice. So it could be the S&P 500 in the US or the FTSE 100 in the UK. For me, again, if you buy into a fund like this, you're mitigating the risks because the chances are that particular country would not go tits up. So again, you're protecting yourself against individual company risks. So what have I learned and what can I share with you? So the first thing is picking individual stocks can be quite time consuming. And buying into a fund is an easier and more risk-averse way of investing in the stock market. Another thing that I learned is when your stocks go down, to control your emotion, what you need to do is have your game plan, have the questions that you want to ask. And if you pass all those questions, then you just sit and wait because the stock market can be quite irrational sometimes. It's not always a science, it's mostly an art, to be honest. And it's driven by sentiment. And that's the thing you need to remember, that when a stock does go down, it doesn't mean that company is suddenly not doing as well. It's just the world's perception of that company is not great at the moment. As long as the company that you're investing in is sound and you still believe that company will make money, then I think you need to stick to your guns and stay with that investment. So I hope you found this useful and thank you very much for watching to the end. If you like this video, please hit the thumbs up button and subscribe. That really does help this channel. Until the next time, goodbye.